This is a special podcast presentation from 700WLW.com. This is Casey Boland on Demand.
Speaking with Casey Boland on the subject of money, and Casey, working with an investment advisor, kind of like you, there's a good chance that somebody might own exchange-traded funds in their portfolio. Explain, if you would, an exchange-traded fund.
Well, you may have heard them be called an ETF. So that's what they are, an exchange-traded fund. They're a great way to invest. They're low cost. You do need to do your homework, though, because not all ETFs have low expenses. But for the most part, many do. You get instant diversification, transparency. That's another key item. You know exactly what you're investing in. While mutual funds, you may have a good idea of what the objective is, but you don't know all the holdings. With an ETF, you know what you're getting. It trades on an exchange, hence the name, so it can be bought and sold throughout the day versus a mutual fund that is bought or sold at the end of the day.
Is it something you would prefer over a mutual fund or simply another investment vehicle?
It's just another investment vehicle. But more and more, you're seeing more use of ETFs. We personally use them more in the domestic area, from the U.S. large cap to small cap, some areas within foreign. So you want to look for where the markets are most efficient. An ETF is a good place to be able to invest because also they're very tax efficient.
Are there downsides to them?
Yeah, there are some downsides to them because they keep inventing. It's one of these things where they throw the products against the wall, see what sticks.
Right.
So the industry keeps coming up with these products. You want to make sure you look for an ETF that has enough liquidity, something that they're investing at least a minimum of $100 million inside them, so that way it'll provide enough liquidity for you. As well as when you invest in them, if they tie to commodities, for an example, you might think, hey, I can buy the move in the price of oil. Some of those don't track as well because they're not purchasing oil itself. They're purchasing futures, so subsequently you could be surprised with underperformance.
You say to watch out for leverage. Explain.
Well, let's say you buy a 2 times leverage ETF. I mean, the concept seems simple. If it goes up 10%, you're up 20%. But on the downside, you could lose a lot with these as well. It may be more than 2 times the leverage, because if you have a security that goes up 10% and you get 2 times that leverage and then it goes down 10% subsequently, well, you're actually going to be down 4 times versus being -1 when you do the